Today's topic: Marvell Technology stocks plus 6.6% risk. Mastering S&P 500 and AI value. Marvell Technology absolutely crushed it recently, wrapping up the week of June 14, 2026, with a massive 6.6% stock jump that completely outpaced the S&P 500's tiny 0.7% gain. This insane divergence is a classic case study of what happens when a semiconductor company catches the perfect wave of AI hype and massive structural changes. While everyone is celebrating the rally, it has created a ton of pressure for the company to deliver absolute perfection in its upcoming operational execution. The real rocket fuel behind this latest surge is the official confirmation that Marvell is finally joining the prestigious S&P 500 index before the opening bell on June 22, 2026. Because of this mandatory inclusion, passive index funds and ETFs are now forced to scramble and buy up an estimated 866 million shares of Marvell to match the index's exact weight. This guaranteed, massive wave of buying pressure is hitting right as the company brings on Dan Durn as its new chief financial officer to keep things steady. Bringing a heavyweight like Dan Durn on board is a brilliant strategic move designed to reassure big institutional investors that Marvell will stay financially disciplined while scaling up. Looking at the bigger picture, Marvell's breathtaking 229% year-to-date surge shows just how incredibly optimistic the market is about its custom silicon role in AI infrastructure. While tech stocks overall felt some pain from a major sector rotation, leaving the Nasdaq Composite with a flat 0.7% gain, Marvell completely defied gravity. The stock got an extra boost of adrenaline when NVIDIA CEO Jensen Huang publicly threw his support behind Marvell, teasing it as a potential future trillion-dollar company. Even with all this amazing momentum, technical indicators like a relative strength index of 63.6 suggest the stock is rapidly approaching dangerous, overbought territory. What's even wilder is that the share price is currently sitting at a jaw-dropping 158% premium over its 200-day moving average, meaning a massive amount of future success is already priced in. Global market sentiment also got a nice lift from geopolitical reports suggesting the Iran war might finally be winding down, easing severe supply chain anxieties. L-Impact Solutions reminds us that while easing geopolitical tensions sound great, the actual lag time for global semiconductor logistics to fully recover is going to take a while. Experienced analysts know that entering the S&P 500 isn't just a fun liquidity party. It's a massive, high-stakes maturity test for any growing tech company. Historically, new index additions often suffer from a nasty pop and drop phenomenon where speculative traders dump the stock right after the official inclusion. To keep this historic 229% rally alive, Marvell can't just rely on passive inflows. It actually has to hit the ambitious 31.5% sales growth projected for fiscal 2027. Right now, the company has a golden, short-term window to convert all this crazy speculative hype into real, long-term shareholder equity. L-Impact Solutions flags a major valuation risk here, pointing out that trading at a demanding 58x P/E ratio leaves the company with absolutely zero margin for error. Investors are essentially paying a massive premium for a flawless performance, which makes the next few quarterly earnings reports incredibly risky. L-Impact Solutions also notes that throwing a brand new CFO into the mix during a hypergrowth phase could create a brief but dangerous corporate governance gap. If the new financial leadership shifts how they communicate or guide the market, it could spark a wave of volatility that shocks new institutional investors. Relying too heavily on bullish analyst upgrades and fragile geopolitical rumors can backfire quickly if the news cycle turns negative. L-Impact Solutions cautions that a single bad headline about supply chains or regional stability could trigger a massive and sudden drop in the share price. There is also a major strategic risk in letting the market pigeonhole Marvell strictly as an exciting AI play while ignoring the rest of its business. Marvell's legacy enterprise networking and carrier segments absolutely have to pull their own weight to justify this massive corporate valuation. At the end of the day, getting added to a passive index is just a fancy capital allocation tool, not a magical substitute for a diversified business strategy. To navigate this volatility smoothly, the new CFO needs to immediately implement a conservative beat and raise guidance strategy for future earnings. By deliberately setting manageable targets for the upcoming Q2 fiscal 2027 call, the finance team can handle slowing growth rates without causing market panic. The executive team needs to loudly remind the street about their success across the wider data infrastructure space, including highly profitable automotive and 5G contracts. To show a unified front, the CEO and the new CFO should launch a joint investor roadshow to prove this leadership transition is a major strategic upgrade. Marvell should capitalize on the current supply chain optimism by immediately locking in long-term shipping rates and conducting transparent inventory audits. To protect themselves from future panic selling, the company needs to educate its new passive shareholder base to focus on steady free cash flow rather than short-term spikes. Long-term volatility prevention means accelerating investments in backup manufacturing hubs across safe, stable regions like North America and Southeast Asia. The ultimate takeaway is that Marvell has officially graduated into a foundational market component, where long-term stability and execution matter way more than short-term velocity. Can Marvell justify a 229% rally without flawless execution? Comment your opinion. Full analysis link in bio. Thank you.